everyone, and welcome to our presentation with title Uber Revival, an in-depth analysis financial turnaround 2021 until 2023. This project is brought to you by our team from University of Indonesia Faculty of Economics and Business. My name is Tania Azhar, my friend Diva Hanalia and Dimas Suryo, and we are under the guidance of our lecturer, Bu Elvia. And today, in this video, we will explore Uber's transformative journey in facing significant challenges to achieving financial growth and stability. So first of all, we start from the business overview of Uber. So Uber Technology was founded in 2009 and has grown into a global technology powerhouse. It operates in three major factors. The first one is ride-hailing. The second one is food delivery through Uber Eats. The third one is freight transportation via Uber Freight. The core of its business model is leveraging technology to connect driver and riders and support by expansion into another service like Uber Health and Uber for Business. Uber has redefined mobility worldwide, impacting millions of users and businesses. Okay, the next one is about Uber issues. In 2022, Uber is facing several challenges, including data breaches exposing sensitive information, ethical concern over breaches of its code of conduct during its expansion, and the last one is persistent struggle in achieving sustainable profitability. These issues not only affect in Uber reputation but also affect them in operational and financial risk. Achieving profitability has been a recurring challenge for Uber due to high operational costs, including driver bonuses and incentive, intense competition from rivals such as Lyft and Didi, regulatory issues such as illegal battles over driver classification, and this factor forced Uber to adopt aggressive pricing and driver retention strategy, which strained its financial sustainability. Uber experienced a major data breaches involving 77,000 drivers' data. These incidents exposed vulnerability in Uber's cybersecurity measure, resulting in significant financial costs for legal settlements, credit monitoring service, and damage control. These breaches highlight the need for robust data protection system to safeguard both the company and its stakeholders. Okay, the next one is breaches of the code of conduct. The Uber Files investigation, conducted by the International Consortium of Investigative Journalists, revealed unethical practice during Uber global expansion from 2013 to 2017. These include aggressive lobbying tactics, tax avoidance, and even exploiting driver violence to gain public sympathy. These practices raise serious ethical and legal concern, damaging Uber reputation and posing long-term risk to its operation. Okay, next, let's jump into concept or theoretical framework. So, our analysis is grounded in quality spectrum of financial reports assessing Uber compliance with US GAAP. While Uber provides decision-useful information, such as detailed segment-level reporting, its earning quality remains a challenge due to high operational costs and reliance on non-operating income and regulatory risk. Uber adheres to US GAAP standards and complement its reports with non-GAAP measures to offer meaningful insights into performance. These include metrics that exclude non-recurring items, enabling stakeholders to better understand its core operational results. Despite this, the company heavy reliance on non-operating income and high operational expenses lowers the overall quality of its earnings. Okay, next about decision-useful information. Uber's financial report excel in delivering decision-useful information by adhering to key qualitative characteristics. The first one is consistency, through standardized metric and segment-level reporting. The second one is verifiability, via external audits and detailed disclosures. And the last one is timeliness, with regular fillings and forward-looking projections. This makes Uber financial data valuable for informed decision-making by investors and stakeholders. Okay, next is about earnings quality. However, Uber's earning quality presents concern. The company's high dependency on non-operating income and persistent operational costs, including research and development, sales and marketing, and regulatory expense, highlight challenges in maintaining high quality and sustainability earnings. Okay, next, it's about analysis tools and techniques. So we employed various financial analysis tools to analyze Uber's performance. The first one is common size analysis, the second one is trend analysis, and the last one is financial ratios. Okay, next we will talk about data breaches and its financial impact. The 2023 data breach had a profound financial impact on Uber. It led to increased legal and security costs, reducing net profit and operating margins. This underscores the importance of prioritizing cybersecurity investment to mitigate such risks in the future. Okay, next is about driver dissatisfaction impact. Driver dissatisfaction pose significant challenges for Uber, and this lead to increased cost for retention strategies such as bonus and incentive. This caused decline in gross profit and EBITDA margins, straining Uber profitability and highlighting the need for better labor relation and cost management. And the last one for me, it's about Uber financial performance. Despite challenges, Uber achieved a significant milestone in 2023.
My name is Divahana, and now I will explain about Uber's financial performance analysis. In this part, our group make an analysis based on Uber's 2021 until 2023 annual report, which consists of income statement, balance sheet, and cash flow statement. The first one is the analysis of the Uber's income statement. Based on its horizontal analysis, Uber's income statement reveals strong top-line growth but challenges in profitability due to escalating costs. Revenue surged by 82% from 2021 to 2022 and by 17% from 2022 to 2023, driven by higher ride volumes and increased demand for delivery services. However, gross profit grew at a slower rate, up 51% in 2022 and 21% in 2023, reflecting persistent cost pressures, particularly in the cost of revenue, which rose significantly from 2021 until 2023. Despite revenue growth, Uber's gross profit margin is hampered by rising costs, including driver incentives, platform maintenance, and delivery subsidies, pointing to inefficiencies in cost management. Although total costs and expenses slowed in 2023, the company faces challenges in achieving sustained profitability. The company's significant loss in 2022 are attributed to lawsuits, penalties, and rising financial obligations, underlining the volatility in profitability due to extraordinary costs and liabilities. The second one is based on trend analysis. From 2021 to 2023, Uber saw substantial revenue growth, with revenues more than doubling from 17.5 billion in 2021 to 37.3 billion in 2023. However, operational costs, especially the cost of revenue, continued to constrain profitability. While gross profit rose by 183%, operating expenses in areas like operations and support and R&D have increased, reflecting significant investments in technology and infrastructure. Despite efforts to optimize spending, such as reducing sales and marketing expenses, these measures have not fully addressed the company's high-cost business model. Uber's recovery to 1.89 billion in net income in 2023, following a 9.14 billion loss in 2022, highlights resilience but also volatility driven by one-time expenses and settlements. The company remains at risk from financial liabilities and ethical controversies, including legal, regulatory challenges related to the data breaches and labor disputes, which threaten long-term stability. The next one is based on common size analysis. In 2023, Uber's revenue increased by 16.95%, largely due to rising demand in ride-hailing and food delivery and its global expansion. However, the cost of revenue remained high, at 60.24% of revenue, driven by legal issues over driver classification and regulatory challenges. Labor-related costs, including driver incentives and bonuses, continue to impact operational expenses. Despite a slight improvement in gross margin, operational inefficiencies persisted, particularly due to the high dependency on driver bonuses. R&D and general and administrative expenses decreased as a percentage of revenue, indicating better cost management. However, legal and reputational costs, driven by issues such as the Uber files and driver classification debates, continue to strain profitability. While Uber posted a positive net income of 5.78% in 2023 after a loss in 2022, ongoing risks like cybersecurity incidents and past scandals pose significant hurdles to long-term profitability. The second one is the analysis of the balance sheet. Based on its horizontal analysis, Uber's financial performance exhibits considerable volatility, revealing challenges in managing profitability and operational costs. From 2021 to 2023, total assets declined sharply by 17.19% in 2022, followed by a rebound of 20.52% in 2023, primarily driven by growth in short-term investments and account receivable. Current liabilities growth by 7% in 2023, while non-current liabilities, notably long-term insurance reserves, saw a substantial increase, highlighting rising operational costs and financial obligation. Although equity showed a partial recovery in 2023 with a growth of 49% after a steep decline in 2022, long-term risks remain due to rising liabilities, declining goodwill, and high operational expense. The growth in restricted investments and insurance reserves signals potential preparations for legal and regulatory liabilities. The next one is based on trend analysis. Uber's financial data presents a scenario of gradual stabilization amid persistent challenges. From 2021 to 2023, current assets increased by 28%, reflecting higher liquidity due to increase in cash equivalents and short-term investments. However, non-current assets, particularly goodwill and intangible assets, declined, indicating potential impairments or reduced returns from acquisitions. Liability rose by 11%, with a sharp increase in both short-term and long-term insurance reserves, signaling heightened operational risk. Despite the recovery of total assets, stockholders' equity dropped by 22.2%, reflecting continued profitability challenges and accumulated deficits. These trends highlight the ongoing financial pressures Uber faces due to rising liabilities, declining goodwill, and increasing operational risk. The next one is based on common size analysis. The common size analysis reveals several key trends in Uber's financial structure. Current assets have increased as a percentage of total assets from 23% in 2021 to 29% in 2023, indicating a focus on improving liquidity. However, the increase in accounts receivable suggests growing revenue but delays in translating this into profitability due to high operating costs. Goodwill and intangible assets declined from 26% to 21% in 2023, likely reflecting impairments or revaluations of past acquisitions. Total liabilities grew from 60.41% in 2021 to 73% in 2022, but decreased to 67% in 2023, reflecting Uber's reliance on external financing to manage its expenses. Equity decreased from 39% in 2022 to 25% in 2022, then rose to 31% in 2023, suggesting financial pressures due to legal challenges and ethical controversies affecting investor confidence. The last one is the analysis of cash flow statement. Based on its horizontal analysis, Uber's financial performance from 2021 to 2023 highlights challenges in profitability and high operational costs. In 2022, the company faced significant losses but returned to profitability in 2023, reflecting the volatility in its financial results. Despite this improvement, Uber continues to struggle with high expenses such as stock-based compensations and impairments, which affect its overall profitability. Additionally, the company experienced negative cash flows from operations in 2021 and 2022, which improved significantly in 2023, indicating a recovery in operational efficiency. Uber's reliance on external funding is evident, and its ability to manage operating costs and achieve sustainable profitability remains uncertain. The company also faces growing financial liabilities, including data breaches, legal challenges, regulatory risk, which contribute to its financial instability and future threats. The next one is based on trend analysis. The trend analysis shows mixed results for Uber's financial performance, with a return to profitability in 2023 after loss in 2021 and 2022. Cash flows from operation improved significantly, demonstrating better cost management and efficiency. However, Uber's high operational expenses, particularly in stock-based compensation and driver incentives, remain a challenge. The company also increased its debt issuance in 2023 to support operations and expansion, contributing to long-term liabilities and exposure to financial risk. Uber's global operations are affected by exchange rate fluctuations, adding complexity to its financial strategy. Despite improvements in profitability and liquidity, ongoing ethical controversies and legal issues pose risks to Uber's long-term financial performance, potentially leading to higher costs, fines, and reputational damage. The last one is based on common size analysis. Uber's common size analysis reveals improvement in cash flow from operating activities, rising from 2% in 2022 to 9% in 2023. This reflects better operational efficiency and cost control. However, cash use in investing activities increased from 5% to 9%, indicating a strategic focus on long-term investments, including purchases of marketable securities. On the financing side, Uber's net cash flow decreased from 0.05% to minus 0.25%, primarily due to increased debt repayments and lower stock issuance proceeds. Despite these increased outflows, Uber's overall cash position showed a slight improvement, with cash and cash equivalents rising by 0.88% of revenue in 2023. The company's profitability is still impacted by high costs, regulatory challenge, and legal battles, as well as risks from data breaches. These factors have led to cautious liquidity management and shifts in Uber's cash flow profile as it balances investment with short-term financial pressures.
Hi everyone, it's Dimas. I'm the other guy. Technically, I'm the only guy here. So yeah, I hope you guys enjoy and understand what Sanya and Diva just explained earlier in this video, but I wanted to show you guys something about this. This is the financial ratio analysis, the application of the research we conduct about the Uber's revival, their turnaround, and the financial impact. So we want to see, we as in me, Sanya, and Diva wanted to see is there any impact from the problem they faced and the strategy they implemented in 2023 through their financial ratio. So the first one is the data breaches and the increased financial liabilities, the liquidity ratios. So yeah, in 2022 they faced several accidents, quote unquote, or problems, anything from cybersecurity accidents through data breaches and everything, which means they have to face it with the direct financial losses like fines, legal fees, the cost of implementing stronger security measures. But look at the number. See, this 2022 and 2023, the number isn't great, of course, I know, but there's improvements, right? Why do we think the liquidity ratios is relevant? It's because the company's ability to handle immediate financial obligations was impaired. Shows, I mean, it shows by the liquidity ratios, right? Okay, it's great. Not great by nominal, but the relative improvement as in the growth is great. Next up is the activity ratios. There's a lot, but what do we think from this? What can we conclude from this? There's an improvement in asset and payables turnover in 2023, which highlights the enhanced operational efficiency that wasn't there in 2022, right? Because they faced several challenges, the operational inefficiencies, the cash flow and asset utilization is not there, it's strained. And the 2023 strategy, they improved, there's recovery, they improved efficiency in utilizing assets, I'm sorry. But yeah, the number of course is not great still, but there's improvement. The thing here is the improvement. They went from loss to profit, which is insane. And the next one is the profitability ratios. Yeah, there were high operational costs in 2022. They came from, like, look at the operating profit margin here. They went from minus, like, negative 5.75% to 2.98%, which is, yeah, roughly around, around 9%, 8%, which is good. Again, the number wasn't great, but the improvement is there. Okay, we need to focus on that. These profitability ratios are relevant because it illustrates the extent of Uber's challenges in controlling cost relative to revenue. The inefficiencies and the high expenses reduced Uber's ability to generate profits. At least that's what happened in 2022. Okay, next one is the ethical controversies and the long-term financial risk. Solvency ratios. We know that in 2022 they were not great. The Uber's aggressive expansion tactics led to multiple breaches of its code of conduct. They weren't great in that. Directly affected the Uber solvency ratios. The long-term financial health is not good. Okay, take a look at this. Debt to equity ratio was 2.92, showing heavy reliance on debt over equity to finance its operations. So the operations as a whole finance through that. The heavy reliance on that is not good. And but look, it's getting better, right? From 2.92 to 2.16. Again, the number wasn't great, but the improvement is there. Next one is market ratios. The PE ratio trailing, the historical. Trailing is the historical and the forward is the forecast. Okay, look at the numbers. Okay, they went down, which means the investors are paying less. They are paying less for the earnings they earn. Get it? Which means it's getting better. Okay, it's not great, but it's a growth company. The number should be around 15 to 10 as a multiplier, but it's 35 and 28. Still not good, but improvement is there. Again, but let's take a look at the ESG report. Okay, they tripled the EVs in the US alone, and the operational costs related to fuel and emissions going down, which means that the operating margin is greater than the years prior. Okay, and this is aligned with the GRI standards number 302 and 305. Okay, they discloses EV adoption metrics and emission reductions to meet GRI 302 and 305. That's great. Next one is the social from the ESG, driver and courier well-being. So there are labor relations and protections and healthcare access to sport programs. This meets the GRI 401, 403, and 413, ensuring transparency in labor relations and worker retention strategies. The gross profit margin went perfectly. So because the reduction in G&A could be because the legal costs and settlements, coupled with increased gross profit margins 2022, indicates the healthier and more satisfied drivers contributed to fewer operational disruptions. Get it? Improving efficiency by reducing absenteeism and associated costs. Again, it's great. The improvement is there. And the last part from the ESG report is governance. Okay, they enhance governance and risk management and the civil rights assessment and ethical practices. The key takeaways from this slide is the total accrued legal, regulatory, and non-income taxes liability decreased from 2.1 billion in 2022 to 1.5 billion. The decrease in the tax liability. See, they do not have those liability in tax that big, anymore. So the key takeaways from Uber part 1 is what are the strategy to come back to the turnaround on the financial performance. First one, they did triple the electric vehicles in 2023 alone in US, enhancing sustainability benefits. As I said before, the GRI, they met the standards. It's great. And then they improved the labor relations. Great again, GRI 401, 403, and 413. And strengthened the governance. They enhanced board oversight of ESG issues likely the corresponding of 2022 data breaches, which may have improved their risk management back in 2022, but it's getting better in 2023. Again, what can we conclude? It's great. Um, yeah, the turnaround is this. They improve the cost management. The revenue growth is there. The evidence of the strategies can be seen from the financial results. The financial ratios shows that it's getting greater. Okay. Okay. The last part. Okay. This is not financial devices. I need to disclaim first. Okay. But the investor recommendation, we are happy with their performance. Of course, they did great in 2023. They have a turnaround in their financial performance. Look, so me, Sanya, and DIFA has already conducted a DCF valuation and found that the fair price of this would be around 122 to 140 USD and now sitting in 61 USD, which means there is like a margin of safety of 50%. And me personally, again, this is not a financial advice. We do not provide any of the financial advice, but there is a margin of safety around 50%. Me personally, my thumb of rule is to I have to accumulate stocks until the margin of safety, I believe, is around 30%, and then I stop to accumulate to buy that. And by that, I mean this is one of the best. Yeah, look at the PE. The PE is around 32 and 25, but the average PE of Uber is around 85. It's way below the average, which means this is one of the best time to buy the stocks. Again, this is not financial advices, but I am more of a skin in the game type of guy. And wait, I need to open my Peluang app. Yeah, as you can see here, the price is at 61 USD. I bought the stocks weeks ago at $58 and it's 61. I'm up like $3 per share, which is good, but it's a long way to be around 182. Yeah, we're happy with their performance, we're happy with their initiatives, we're happy with their ideas, and we firmly believe with strong fundamentals and continuous innovation that Uber is poised to capitalize on its market leadership in 2024 and beyond. So yeah, that is pretty much all. I hope you guys understand what uh, financial reporting is, what financial ratios is, what GRI, uh, how do we see if there is a financial shenanigans, and then at the very end, I hope you guys understand and know how to value a company, whether it is a good buy or a good sell. So yeah, that is pretty much all. The list of references is here, pretty much from Forbes, WSG, Wall Street Journal, and Yahoo Finance. That's pretty much all. Thank you.